Minasan, konnichiwa. Zamurai Engineer desu. In this video, we'll now jump to the next chapter, which is chapter 6. This is the first module. So, chapter 6 will deal with cost, volume, profit relationship. So, let us go on to the first module, learning goals. So, what is the learning goal for this module? So our learning goal is to be able to learn how changes in activity affect contribution margin and net income of our company. So contribution margin minus something, we have net income or net operating income. Okay, so that is our formula. That's why we need to know what type of manner, in what manner does our contribution margin affect the net income? Because we are particular with our net income. Okay. Basic of cost volume analysis. The contribution income statement is helpful to managers in judging the impact of profits on changes in selling price, cost, or volume. So price, cost, volume, profit. The emphasis is on behavior because we would like to look into trends, because we would like to what managers wants to predict the outcome, the future. It doesn't matter if our prediction is accurate or not, or their degree of precision, our prediction, but it is the manager's job to predict the result so that you can plan ahead. You have to lay down the plans. Okay. So, for example, in an example racing bicycle company, like on your screen, we have the month of June income statement. So this type is what? The contribution income statement type of report. Okay. Why? We already know that if we have the contribution margin, this is the type of income statement that we call contribution income statement. So sales, there are 500 units of bicycles sold during that month. So we have what? 250,000 sales less variable expenses, and therefore we can get the contribution margin if we subtract variable expenses from the sales. Okay, so in this instance, we have what? Contribution margin equals to $100,000. So if we want to determine the net operating income, we have to subtract again the fixed expenses. So the contribution type of income statement is a type of income statement wherein we separate the variable and fixed cost. That is a review. We already know that on the last chapter. So fixed expenses is 80,000. Therefore, we only have 20,000 as our net operating income. So contribution margin is the amount remaining from sales revenue after variable expenses have been deducted. Okay, let us continue. Again, basics of cost, volume, profit analysis. The same example, but you'll notice CM. What do you mean by CM? Contribution margin. Contribution margin is used first to cover fixed expenses. Any remaining contribution margin contributes to net operating income. So that is an equation. This statement is an equation that net operating income is equal to contribution margin minus fixed expenses. Okay? If we translate this statement into an equation, again, net operating income is equal to contribution margin minus fixed expenses. And from the previous slide, we have what? Contribution margin is equal to sales minus variable expenses. So by using the contribution margin, wherein this factor is related both with variable expenses and fixed expenses. Okay. If you subtract fixed expenses from contribution margin, you will get the important data, which is the net income. Okay. So meaning contribution margin covers first the fixed expenses, and included in the contribution margin is sales minus the variable expenses. So there's no variable expenses in our contribution margin. Okay. Or in other words, variable expenses plus contribution margin, this is equal to sales. Okay. That is the same thing. So contribution margin approach. The contribution approach, sales, variable expenses, and contribution margin can also be expressed on a per unit basis. Can also do it per unit, not just the total sales, total expenses, total variable expenses, and total contribution margin. So per unit, we can look into the same example. If RBC, which stands for Racing Bicycle Company, sells an additional bicycle, $200 additional contribution margin will be generated to cover fixed expenses and profit. So that is per unit basis. Okay. As you can see on the table, there are 500 bicycles. So 500 less variable expenses, that is 300. So therefore, $200 is still there to cover the fixed expenses. And after covering fixed expenses, we will be having our net income. If and only if our contribution margin is bigger than the fixed expenses. So continued, each month the company must, the example company, which is a racing bicycle company, must generate at least $80,000 in total contribution margin to break even. Okay, just to break even. If you have contribution margin is equal to fixed expenses, you do not have income. You have zero income, meaning you are break even, which is the level of sales at which profit is zero. You have zero profit. So we need to have a contribution margin greater than fixed expenses. Okay. So the contribution approach continued. We have the same example. If and only if our company racing bicycle only sells 400 units in a month rather than the 500 as an example previously. If only 400, therefore it will be an operating at break-even point. Okay? So because 200, 400 bicycle is equivalent to $200,000. If you subtract variable expenses, the result of contribution margin is $80,000, which is equal to fixed expenses. Therefore, if you subtract, there is no income, zero net income. Okay, so meaning we are in the break-even point. So therefore, your employees must target to sell more than 400, basically, to be able to have an income. If our BC sells one more bike, well, that means 401 bicycle, operating income will increase by 200 because one bicycle is worth $200. That is the income. So any sales more than 400 bike is our net income. Okay. We do not need to prepare an income statement to estimate profits at a particular sales volume. Simply multiply the number of units sold above break-even by the contribution margin per unit. So our contribution margin per unit is how much? Okay. To 200. So the 200 contribution margin times how many units you sold over or more than the break-even point. So if racing bicycle company sells 430, therefore the break-even point is 400. So therefore 30 bicycle more than the break-even. So 30 times 200, that is our net operating income. What is 30 times 200? That is 6,000. So our net income would be 6,000. Okay. Take a look at that's why it is also important to be able to express contribution margin per unit, because it is easier to look at that per unit times the number of bicycles sold more than the break-even point. Okay, so just like in this instance, you have per unit contribution margin, as you can see on the table, equal to what? $200. How many bicycles are over or more than the break-even point of 400? 401 minus 400, that is 1. 1 bicycle is over. So 1 times 200, our net income is 200. That is how we can easily be able to evaluate our profit. So as you can see in this formula, you can look at the black background here. Formula, profit is equal to quantity sales minus variable expenses minus fixed expenses. Okay. What do we mean by CVP? CVP means cost, volume, profit. Cost, volume, profit. Okay. This equation can be used to show the profit of racing bicycle company earns if it sells 401 units. Notice the answer is 200. Okay. So that is sales. Okay, as you can see here. As you can see here, minus fixed. So the answer would be 200. Okay, if you multiply this, you multiply 401 times 500, that is 200,500. 401 times 300, that is 120,300. And if you subtract that, and the result also is needed, because we need again to subtract 80,000 from that, the answer would be 200. Okay, is it clear? This is our example. You can look back. You have to look back at the table to find out these values. Okay. Okay. When a company has only one product, we can further refine this equation as shown in this slide. If the company has only one product, profit is equal to sales minus variable expenses minus fixed expenses. So sales is what we call quantity sold times selling price per unit. So that is what? Q times P. And variable expenses, that is quantity sold times variable expenses. Almost easily understood because it is logical. Variable expenses per unit, V. So Q times V. So therefore, our quantity sales minus variable expenses is just equal to QP minus QV. Okay. So QP minus QV or PQ minus BQ. Okay. You can even factor out Q. Okay. So that you will be left by Q times quantity P minus V. Okay. As you can see, P is our selling price. Okay. Another, this is our summary of that. And because we have the example, let us proceed with our example. P, we are doing this per unit. Okay. So 500 times 401 minus 300 times 401 minus 80,000. Fixed expenses 80,000 here. Okay. So if you evaluate that, okay. So you have that answer. So it is often useful to express this simple profit equation in terms of unit contribution margin. So not only the total, but unit contribution margin is also important because it is equal to selling price per unit minus variable expenses per unit. Therefore, it is equal to P minus V, selling price minus variable expenses per unit. Okay. So therefore, if you factor out Q here, you factor out Q, algebra, P times Q minus B times Q, you can factor out Q. That is quantity P minus B times Q. Okay. And P minus B is just what? As you can see here, that is just equal to unit contribution margin. So unit CM times Q minus fixed expenses. That is a simple formula that can be derived. So again, that is the formula. And if we apply that to our example, we have what? Look at our sample. What is our price per unit? 500. Our variable expense per unit is 300. And our quantity sold, that is 401. So that is our data information from the example. So if you simplify 500 minus 300, that is 200 times 401, that is 401. And lastly, subtract 80,000. So 80,200 minus 80,000, of course, that is $200. This equation can also be used to compute racing bicycle companies 200 profit if it sells 401 bikes. So you can choose which one do you want to use. So there are two ways in order to solve this problem. Okay. So that is the last slide, I think, because we are now on the next learning goal, which is the next module. And because of that, we would like to remind everybody to please understand our lecture. And if you have any question, please use our comment box below. And then again, this is Dr. EYPEI, Preaching Engineering for Nation Building.